Welcome to the abbreviated edition of the daily video update. I'll go over the action in the market for Monday, August 1st, and then see how things look for Tuesday, August 2nd. And the scenario that we've been looking at, where the market seems to be thinking that inflation has topped and is starting to come back down. I have a few charts to go through to show you how they're thinking that. Now, please remember that we got faked out by this not too long ago, where the market started to shift, thinking that maybe the Fed will pivot from being more aggressive with their rate hikes to easing. That didn't really work out. And the inflation scenario ended up picking up even more. So we have to be careful of that. We need to keep that in the back of our mind while the market is trying to anticipate where things are headed right now. Because remember, the market is always forward looking. And so sometimes there can be a disconnect by what we're seeing in our everyday lives and what the market is thinking will happen into the future. Now, we have to follow that until the evidence suggests that we were either wrong about that and we have to shift how we're looking, or it'll confirm that, okay, the market was right about this, and then we can just keep things the way we've been looking at them. But that's pretty much the scenario right now, that we're getting some support because inflation seems to be coming down. Inflation might be getting more under control, and interest rates continue to fall, and that's giving some support to stocks. Now, if you see the chart in front of you, we had a bit of a down day because we had gone up pretty far pretty fast. And so some of our indicators are looking, at least on the short term, looking a little more extreme positive. So the fact that we had a sideways to slightly down day is helping to wear off some of those indicators, but at the same time, they haven't worn off completely yet. So how we opened in Monday's session was we had a gap lower, and it thought, then I was thinking that, okay, we're just going to have a bit of a down day, but you can't really judge things by the open. We were able to bounce back up. We came back down to the pivot, went a little bit higher and went sideways, but we were positive for a lot of the day. Things really started to slow down. That's when these bars get smaller. That means that there's not a lot of activity going on. We drifted back down, went below the pivot, were able to come back above it, closer to the close, and then pretty much went sideways into the close. So yeah, it was a down day, but it hasn't changed that our indicators are still looking positive, but we are still a little bit overextended in the short term. Here's the daily chart just showing how volume really dropped off, and we're really into the dog days of summer now. Now, there have been times in the past when August has been a pretty crazy month, but typically, if you were ever going to take a vacation in the stock market, they tend to do that in August. It can get pretty slow and kind of dull, but we still have to keep watching things anyway. Where here's the bar from Monday's session where we tried to break up a little bit above Friday's bar, but then we came down. We're still above the pivot level right here. So that's providing some support. And we have this longer term support down below where we're at. If things do start to turn more negative, we're going to be keeping an eye on this because it could change the environment. But right now, it's still looking much more positive. Is an Isabel net chart, and I have a few of those to go through. This is just showing what are the projections, not only for the US with GDP, but all over the world. And if you take the world all together, GDP was at 6.1. 2022, they're projecting it to be 3.2 overall. And then into 2023, 2.9. Now, how realistic is that? Who knows? These are just projections. Here's the US projection, where we had been at 5.7 in 2021. They're still thinking that we're going to have positive GDP after this, that things are going to improve at 2.3, and then GDP will be very low in 2023, but still positive. And here's all the other areas. None of them are looking negative right now, at least on an overall GDP basis. Another chart is just showing how inflation, according to this chart, is really falling, where it had gone up here to 1.32. Well, now it has dropped down to 0.27. There's still inflation, but it has really declined recently. Another chart is just showing the earnings per share. That's another thing that we really want to keep an eye on. If the analysts out there start lowering the projections for earnings for companies, that's going to bleed over into the price of stocks and ultimately into the S&P 500 itself. So we want to keep an eye on this because that's what is used to justify price. We're here, Goldman Sachs, they keep adjusting this all the time, but they're still projecting that earnings are going to go up. And then overall, the earnings, they predict then that based on the earnings projection that they have, that by the end of 2022, the S&P should be at about 4,300. So that would help hold things up more. And we're below that right now. So that would mean that the S&P would advance from here. But again, these are just projections, but these are projections that the market uses. Then looking at sentiment, which we haven't really looked at too much lately, we're still more towards neutral, but leaning more towards the positive side, according to this. Now, the CNN chart that we look at every day is still leaning over more towards the fear category. It's not neutral at this point, and it's not positive. It's just slightly into the fear camp, which could provide some support to the market because you've got a lot of disbelievers out there that the market is going to keep going up. Also, in Monday's session, I have to make this bigger. We started out pretty good when we're looking at value and growth, where growth was really up strong, but then it pulled back as the day went on. It ended up being down just a little bit less than growth, where in the large caps, everything was down for the day, where the mid caps and the small caps fared a little better. So even though we look at the large caps, since that's the S&P 500, these other areas can provide some support to the S&P. Maybe not on Monday, but as we're trying to work out this scenario that value is not where the market's at right now, and that the smart money is moving back into growth. Then this kind of shows that. Here's one of our scenarios that just shows the Qs were pretty much flat when compared to the S&P. So growth is still holding up there. Discretionary had another good day. It was actually up again. And then the large cap growth against value was pretty much flat. So even though we had a down day, we're slowing down a little bit right now. And plus, because of the time of year that it is, with a lot of people on vacations, this is still holding up, at least for right now. But this could change at any time. Also, looking at the growth value ratio with the large, mid, and small caps just shows pretty much flat on the day, but we're still above the moving average, and the moving average is going ever so slightly higher. So that's still hanging in there for that scenario. We're still doing okay as far as the moving averages. These are the intermediate term moving averages, where we're at the top of the rainbow, even though we declined a bit in Monday's session. Here's the long-term rainbow, where we're coming up into the underside. We have some moving averages still above where we're at right now, but things are still hanging in there. Here's the 100-day moving average. That seems to be what the S&P is dealing with right now. We got above the 20, we got above the 50. Now we're trying to see, can we get above the 100 moving average? And this is both the exponential and the simple moving average. And we're right on the simple moving average. Here's our moving average tree, again, showing how we've been coming up. The shorter term moving averages are starting to turn up, so that's positive, and we're right at the 100 period moving average. But we have these longer term moving averages still above where we're at. Looking at some correlations, we're still seeing an inverse correlation between interest rates and the S&P. So if the S&P is going down, interest rates are going up, and vice versa. And so it's not a really, really strong relationship, but it's still a pretty strong inverse relationship. And the same thing with the 10-year, where we want to keep an eye on interest rates. If bonds are up and interest rates are down, that should give some support to stocks. Then looking at the dollar's been showing a little bit of weakness lately, but it's still in an overall uptrend. But if the dollar's down, then that helps the S&P to go up. And it was kind of interesting, before the market opened for Monday's session, both the S&P futures and the dollar were down. And that was telling me that that could give some support to the S&P, which we saw for the early part of the day on Monday. That ended up wearing off, but those are the things that I've been watching lately. So keep an eye on the tech sector, on the Qs, the dollar, and bonds or interest rates, just to see, because they're tending to move in opposite directions right now. Here's the tech sector to the 10-year yield. They're also moving in opposite directions. Then our trend, it's the ADX is starting to come back up. We're above the moving average and the green line is on top. But if you're more conservative with this, we're still below 20 right now. But if you're more aggressive with this, maybe you're are taking this as okay, we have a new trend. And since the green line's on top, that means the trend is positive. The Swinland trading oscillator, I've been watching that a lot lately because sometimes it's leading us a little bit and has been conflicting at times. And then the market can sometimes follow what this indicator is telling us. Right now, we were pretty much flat based on price, but we still continue to advance and are slightly flat based on volume. This is where we're getting a little topsy in some of our short-term indicators, the Stochc RSI, stochastics, the Williams percent R. Those indicators are still pretty extreme positive, but we're also seeing some extreme positive readings with the rate of change going back 5 periods, even though it did decline slightly. But if you look at the 10, it's still pretty extreme positive. And with the 20, even though it declined, it's still pretty extreme positive. We had a pretty nice run up last week. And so right now, it looks like the markets are just trying to work that off. But as I said before, if we start to turn and really go down, we'll want to watch the intensity of any downward movement. The elder system for the S&P continues to be positive. And then another thing to be aware of is one of the fib charts that we look at going back to a low set in 2021. We're coming back up to this 61.8% retracement. This could be acting as resistance. We not only have resistance on this chart, but see where we were in this really sideways trend for a while back in June. And it would be a lot more positive if price could break above this, or we might end up going back down a little bit from this level. Also looking at the 2-year, because interest rates continue to fall, this is still looking like it could be a spike, but again, it's hard to do this in real time to know, because really in hindsight is when we know whether this would have worked or not, but we still want to keep an eye on this anyway. The staples were up pretty strong in Monday's session, but overall, the ratio between the S&P and staples, it still looks like this is a valid spike that we're working off of. We've had 3 now, right about at the same level, but we want to keep an eye on this ratio to make sure that it continues to fall. If it doesn't and turns around and goes the other way, it might wipe out the validity of this spike. But as long as we stay below this, it's looking like that spike is valid. Then looking at bonds, where we're still seeing some improvement in the world bond index, where we had the base down here and we're starting to go up. And then here's the yields, just showing overall, even in a high inflationary, very uncertain, recession-laden environment right now, we're still seeing interest rates coming down, at least the longer term. But look how the shorter interest rate, especially the 3 month, has really been going up. And this is why all these lines look so crazy, because we have parts of it that are inverted. They're really bunching up to each other, and that just shows a lot of economic uncertainty. Then the last chart is just something that we're keeping an eye on. We still have the 10-year to the 5-year inverted and the 10 to the 2 inverted. Now we're watching the 10-year to the 3 month, and this is continuing to fall. We're not into this red area yet, so it has not gone inverted, but we just want to keep an eye on this to see if it will end up going inverted after all. So that concludes the charts I wanted to show. I'm hoping that I can get things more back to doing the longer videos here pretty soon. Things are moving in the right direction with that, but I'm still not at that point where I'm able to really do the PowerPoint and the longer videos that I have been doing before. So have a great day, and I will look at preparing the next video after Tuesday's session.